Video T11A is on the good old corporation. Often maligned for its double taxation and rigid structure, it has also been the most widely used choice for generating large aggregations of capital for years. Virtually every public company in the U.S. is organized as a corporation, and those pesky shareholder restrictions prevent an S election. The new tax law's 21% corporate tax rate should increase the popularity of the corporate form as well. In spite of the frequent use of the corporate form for large public companies, many of the tax laws are built to deal with the closely held corporate form. Situations in which a shareholder or small group of shareholders can exert influence over the behavior of the supposedly separate corporate entity earn the same level of scrutiny as the non-arm's length related party issues we discussed in earlier modules. The corporate form often includes the use of multiple subsidiaries. It is not unusual for large public corporations to have dozens of subsidiaries. Typically, these corporations file a consolidated tax return, and the tax rules require them to do so or pay tax at the same rate the consolidated entity would. This was a much more important issue when corporate tax rates were progressive. Otherwise, a large corporation subject to 34 or 35% could simply form enough subsidiaries to divide the income among the subs to lower the tax rates. Consolidated returns are not always bad. For example, assume you have one subsidiary that has lots of taxable income, and the other subsidiary has a taxable loss. If they were to file separately, they pay tax on the $100,000, and the loss would have to be either carried back if available or forward. Whereas if they file a consolidated return, they would only have to pay tax on the $40,000 of net income between the two. Therefore, the benefit of that loss would be received immediately. Recall the framework of calculating business income. Gross income less deductions. No AGI, no standard deduction, no itemized deductions. Corporations file a Form 1120, but unlike the previous pass-through entities, a corporation is a tax-paying entity, and the return captures the tax liability for the year. Consistent with just about every other business entity, page 1 of the form is dedicated to the calculation of business income. But you will not find a Schedule K or a Schedule K1 with a corporation, because income does not flow through and does not retain its character. With such a simple formula for taxable income, there are not many unique elements for a corporation. However, there are two such items we're going to deal with: charitable contributions and the dividends received deduction. The tax law limits a corporation's deduction for charitable contributions to 10% of its income. Note that this is much lower than the individual limits, for example, 60% for cash contributions. This strict limit prevents closely held corporations from making donations to pet charitable organizations of the owner, which would avoid the double taxation that would occur if the corporation distributed the earnings to the shareholder and then they made individual donations. Thus, if Crimer Corp. makes a $14,000 charitable contribution and has taxable income of $95,000, the deduction for the charitable contribution will be limited to $9,500, which is $95,000 times 10%. The excess $4,500 donation can be carried forward for up to 5 years. As we discussed, corporations often operate subsidiaries, and sometimes those subsidiaries also have their own subsidiaries. Because each corporation can be taxed separately, if a corporation pays a dividend to its parent, then that income is double taxed. Then, if it's paid upstream to another corporate parent, it's triple taxed. And then when distributed to the individual shareholders, it would be quadruple taxed. To avoid this, corporations are eligible for a dividends received deduction. In the simplest version, if parent corporation owns 100% of subcorp, and subcorp pays a $100 dividend, parent corp must include the $100 dividend in its income, but it will take an offsetting $100 dividends received deduction, making the net tax effect 0. The level of ownership affects the percentage of the dividends that can be deducted. This table presents the ownership percentages and commensurate DRD percentages under the old and the new tax law. Note that the DRD is also limited to the same percent multiplied by taxable income. Let's do a quick example. So if parent owns 95% of child, then the DRD percentage is 100%, and thus the DRD is $100 times 100%, or simply $100. If the parent owns only 75%, then the DRD percentage drops to 65%, and thus the DRD is only $65. Lastly, if ownership is only 17%, then the DRD percentage is 50%, and thus only $50 of DRD is available. In none of these examples is the DRD limited to income. You might also hear about something called the Domestic Production Activities Deduction, or the DPAD. This was repealed in the new tax law, and so it's dead to me. Well, there's our stroll through the corporation, and we are at the end of video T11A. But we are not through with corporations yet. In fact, we have 2 more videos on this topic. Thanks for watching.